Hello, Arkansas, and welcome to this week's edition of Arkansas Money Talk, brought to you by the team of Retire Path Wealth. I'm your host, Kristen Oakley, and I'm joined by the President of Wealth Management, Dale Colclasure, and co-founder, Mark Smalling. We've got a great show for you today. The title of this episode is How to Remove Your Wealth from Washington. And if you are uncertain about what your tax burden might be in retirement and what steps you can take even now to begin minimizing it, you're not going to want to miss today's show. Dale, Mark, so good to be here with both of you as it is each and every week. How are you?
It's a great day. Love talking about the idea of how to minimize the effect of taxes, because so often when we ask people, about their tax situation, their response is, oh, well, I don't pay anything in April, because that's about what they understand.
Right. Yep. Yeah. Well, and really what folks don't realize, I think, we've all heard that saying, there's two certainties in life, death and taxes, right? Ma'am. Thanks to Ben Franklin. But when you put death, which is something we have no control over, in with taxes, it makes folks think that they don't have control, but they actually have more control than they might realize, right?
They really do. I mean, there's a lot of things, a lot of the things you're doing today, planning for retirement, the way you contribute to your retirement accounts, and whether or not you have Roth contributions available and how you're putting money back. The things you do today are going to affect you in the future. And those are things that we always try to address with people that come in, and no one's really ever talked to them about taxes in their retirement. It's kind of, taxes are what they are. But if we plan properly, especially leading into retirement, we can actually write our own tax plan in retirement. It's something that most people don't get to do while they're still working, because you're receiving a paycheck and taxes are being withheld. And if you earn a certain amount of money, you're going to be in certain tax brackets. But once you get to retirement and you can decide where you're going to pull income from throughout retirement, you actually do have a lot of control over that.
Right. Well, as we set up today's conversation, a couple of things I think it's important just to set the context for this subject matter. Why would you say it's more crucial than ever for folks to pay attention to their potential tax bill in retirement?
Oh, I love the way you phrase that. I'm going to go back to a resource that we've been utilizing so far this year, where the largest concerns that people entering retirement have. Everybody's worried about inflation. Everybody's worried about a drop in the market, all this volatility that we've been having, which again, we see is exactly going to continue into the near future just because of all this uncertainty. And then the fact I'm worried about outliving my assets, where are all things that literally the first two, we literally have no control whatsoever over it all. But the reality is that so many of us have been trained to the CPA mindset of, let me minimize my tax burden today. What can I do to affect this year? Because that's what I can control. Where the reality is, as Mark's already mentioned, how you structure your investments today, how I draw income, how I begin to position things not only affects my tax liability today, but it's going to affect my tax liability into the future. At some point, whenever, if we're a married couple, when one of us is going to be a single tax filer, that widow's penalty that you hear referred to, and then also the taxation on the assets I'm going to leave either to the next generation or to charity or whatever in the future, all is based on what things I do today.
And talk a little bit about, now that we have the One Big Beautiful Bill that's passed, why it's such a time-sensitive issue. What is it that folks need to understand about recent legislation changes that makes this even more important for them to be focusing on right now?
Well, I mean, it's the first time that we've actually had the tax code change in the middle of the year. And so, they increased standard deduction, they increased senior deductions for folks that are receiving their Social Security benefits and are over age 65. So we have a lot of clients that are coming in that have been looking at deferring their Social Security. Now we're wondering, do we need to go ahead and take it because of that? Does that make sense today? Roth conversions, we thought that the tax code was going to be sunsetting at the end of 2025. That's actually been extended. So we still have some of the lowest taxes or the lowest taxes in most of our lifetimes that we currently have available to us. But we also have the national debt that's ticking up. So we think that in the future, taxes are going to have to go up at some point in time, but they're not yet. So this is a great time to start looking at some Roth conversion strategies. A lot of people come in and go, well, gosh, I make too much money to contribute to a Roth. Well, there's no limit on what you make when it comes to Roth conversions and the ability to do those.
Yes.
So those are all things that need to be considered.
Well, not only that, there's no limit on your income for an in-plan Roth opportunity. And there's a lot of plans out there that now have the availability to make after-tax contributions, which can immediately be converted to Roth as well. Also, as Mark's already mentioned, we get the extension of the current tax code, but so many provisions that were passed in that big, beautiful bill are only good for the next 3 tax years now. Since we're in 2026, we know we have this year and the next 2. So even though we think we have short-term certainty, there's a lot of plans that may make sense to implement today to benefit
Right, to take advantage of where we're at.
Before things do change, because we do believe they will.
Right, and right now we are in the 3rd lowest tax brackets that we've ever been in the history of our country. And I think once folks realize that, right, really awareness is the first step. And this is why we want to share with you today a very powerful resource. We have brought this up on the show before. It always gets a huge response. It's very eye-opening. So we're going to put this site for you here on the bottom of your screen. And we invite you to visit retirepathtaxtest.com. You can go to that webpage or you can click that QR code. I'll walk our viewers through what they're going to see. But before we do that, why is it so important to you all to be able to share this information with our viewers?
The main reason is because so many people have been told, because the focus of our audience is we're older, we're getting closer to retirement, is I'm too old to take advantage of Roth. I'm too old to take advantage of these because I don't have enough time. I think so many people, again, we're in that CPA mindset where I'm stuck and focusing only in this year. But the reality is changes I make in my tax code today in my investment structure are going to affect me for the rest of my life. They're going to affect my spouse for the rest of their lives. And then there's a 10-year provision that I have the ability for even my beneficiaries to take advantage of those opportunities. So I've got a much longer runway to take advantage of those tax opportunities than what I generally think I do in most cases.
Right. Well, let's walk our viewers through what they're going to see. So again, grab your smartphone. We know it's laying right there. You can get there 2 ways. Either go to retirepathtaxtest.com or scan that QR code. And here is what you're going to see. It's going to take you to the simple landing page, ask you for some basic information, no strings attached. It'll ask you for your name, the email address that you want your complimentary report sent to, and your current age. Why? Because what this tool is going to do for you is calculate your potential tax bill throughout the rest of your life. Then you're going to put in how much money you have saved up in tax deferred accounts. For you, that could be a traditional 401k, traditional IRA, things of that nature. You'll notice there's 2 little sliders down at the bottom that you can play around with and adjust. You can adjust your assumed tax liability as well as the assumed growth rate on that tax deferred bucket of money. Then once you click submit, 2 things are going to happen. First, instantly, you're going to see a side-by-side comparison of the difference between the government's tax plan for you if you do nothing versus how much less you could pay in tax there on the right-hand side of your screen if you enact some of the strategic tax planning that we're going to continue talking about throughout the rest of today's show. But then you're also going to receive a complimentary 4-page report emailed to you showing you the breakdown of your numbers. This is one screenshot of 1 page of that report. And Dale and Mark, I know that you have had folks go to retirepathtaxtest.com. They print off this page, they print off the report, they come into you and literally they're going, help me figure out how to remove Washington from my wealth, right? Look at the difference there between the left-hand side and the right-hand side of the screen. It's mind-blowing.
Right. It's huge. And those are things, and this is what we talk about every day, and that we think it's one of the things that makes us different at RetirePath is we do believe in complete planning. Mm-hmm. And if you don't have someone out there that's actually talking to you about your retirement plans, taxes, how all these different things are going to affect you going forward, please pick up the phone and give us a call, scan the QR code. We'd love to schedule a time to meet with you.
Wonderful. I'm excited to dive more into this because I know we just opened a can of worms here on the show, right? But Dale, Mark, thank you so much. Again, awareness is the first step, but the real way the team of RetirePath Wealth is going to be able to help and serve you is by you coming in, sitting down, looking at your individual situation and developing your very own complimentary written income plan for you, which of course part of that is this strategic tax planning as well. So to claim yours, all you need to do is call 866-724-3700. 3893, or you're welcome to scan that QR code and that will get you connected as well. Stay with us. We're going to share more about the strategies of how you can remove Washington from your wealth right after this.
We're based in Little Rock, Arkansas. We're licensed literally in 37 states, though, so we can reach across the realm. The greatest benefit of being independent is simply choice, but always having basically the entire investment universe to go search for the best answers for individual clients and then helping to narrow that down. We do a very solid job up front in our data gathering process of not just getting information, but getting a sense of feeling, what a client's real objectives and long-term goals are based on where their finances are. From years and years of doing what we believe is simply doing the right thing, we're going to find and get that answer for you, not, hey, here's someone else you can call, see if they can answer this question for you. We like to have those resources on hand. Did you know Uncle Sam might be your partner in retirement? It's true. If you have a 401k, IRA, pension, or other similar retirement accounts, they're all tax targets. But how much? Get our easy-to-use tax calculator and plug in the numbers yourself. Go to retirepathtaxtest.com and find out your potential tax hit.
Welcome back to Arkansas Money Talk. I'm Kristen Oakley here with both Dale and Mark from Retire Path Wealth, and we're so glad that you're joining us today. If you're just tuning in, today's conversation is all about how to remove your wealth from Washington. Translation, how do you keep more of your hard-earned money and not have it more subject to taxation than it needs to be? A lot of folks aren't aware that they have more control over their tax bill in retirement, and so that's why we want to raise awareness. And we did just share with you a very helpful site that we encourage you to visit if you've not yet done so. That site is retirepathtaxtest.com, or you can get there by clicking that QR code. It will instantly show you the difference between the government's tax plan for you if you do nothing versus how much less you could pay in tax with some strategic tax planning, which is what you all specialize in doing for your clients. As we said earlier, it is so eye-opening to see the difference between those two. And of course, one of the strategies, you mentioned this earlier in the show, but I think we need to dive a little more deeply into it, that you often employ for a lot of your clients is Roth conversions.
That's right.
I know there's a lot of confusion out there. Can you just define it for us? Let's break it down and help folks understand what actually goes into doing these Roth conversions.
I appreciate that, Kristen. And I would like to share two very specific stories, client stories that occurred this year.
Okay.
The first one is, had a gentleman run the calculator, still is employed, but happens to work for a nonprofit institution that has a 403B plan. So he's sitting here thinking, gosh, I have this humongous issue because I think he had roughly about $3.8 million in this 403B plan. His intention was not to retire anytime in the near future, but was trying to figure out, gosh, how do I take advantage of this opportunity that's there because I have this money that I can't do anything with because it's my employer's plan. Well, what he didn't know and understand was that because he's in a 403B plan, he has and is over 59 and a half years old, he has access to in-service distributions, which he can then move that money from the 403B plan to an outside IRA account, is the first step. So we have to go like to like, tax deferred. Then we can open a Roth IRA account and do the conversion amount up to that amount. One of the other things he hadn't even thought about was, gosh, if this is my concern, why am I still tax deferring money into a deferred account? Why am I not making those contributions into Roth? So we're able to show him the difference and what those making that change would do in the future. Because again, the biggest issue that everybody has to get over is the fact that I'm going to increase my tax liability today.
When you do the conversions,
That is exactly correct.
Yep.
But again, as you've already illustrated, we're in the probably the lowest or the third lowest marginal tax brackets we've ever been in our lifetime. So it makes sense to make those changes today. In some cases, again, it's not for everybody.
Yeah, it's not a one-size-fits-all, right?
Which is why the tax calculator is the first step, and then putting the written income plan into place is the next step after that. So that's how we get introduced to the process. But the reality is we were able to begin to move money from the qualified account and start making those conversions up to the top of certain tax brackets that made sense today, even while he's still working. He's not even separated service yet. He's still contributing to his plan, but we made the changes as well so that we quit exacerbating this tax issue moving forward. The other very specific option was we had another group of clients run the exact same scenario. They're already retired. But again, they've been leaving their money in their employer's plan because it's cheaper to do it that way.
That's what they were led to believe, right?
Was their thought.
Right.
And then all of a sudden, he's turning 72 years old. There's an age disparity between the spouses. Again, another scenario of a large sum of money in qualified accounts. But they began to realize, gosh, I'm going to have these RMDs next year. And
it's required, so it's non-negotiable. It means you have to take the money out, whether you need it or not, right?
I got to do something.
Yep.
But the younger spouse is the one that's beginning to realize, gosh, it would make a lot of sense if I had a strategic plan for how to convert this money that I'm going to pay taxes on as a single taxpayer for probably 15 to 20 years. How do I lessen that tax burden that's going to be on that surviving spouse today by starting those institutions today? So we've put together a strategic plan for what we're going to do this year. Again, we've already explained the process where we move from the qualified plan to a traditional IRA, then convert the money to a Roth. The next step that is so important is that we focus on is doing annual income planning with every single client each year, where we know what our income sources are going to be, we structure to what tax code is going to be, and then we come up with a strategic plan of how to access efficiently as much money as we possibly can that makes sense in these lower tax brackets.
Thank you for explaining those stories and scenarios. And one thing that stands out to me is the sooner someone starts down this process, the easier it's going to be. It's not something that you typically want to do all at once, right? And create a massive tax bill. It's something that needs to be done with a lot of thought, planning, and strategy. And Mark, something that you said earlier in the show that I think is important for folks to understand. There are limits on how much you can contribute to a Roth. So if you make too much money, some folks haven't been eligible to contribute to a Roth IRA, correct?
That's correct.
But there's no limit when it comes to Roth conversion. Explain that, because I think that's where a lot of folks get tripped up.
Well, a lot of people, they hear things, and it's the misinformation that's out there, and that's one of the reasons why we do this show is to actually talk about things that a lot of people misunderstand.
They thought they knew.
They thought they knew. They heard from somebody they worked with or a family member.
Yep.
But when it comes to Roth conversions, or as Dale was talking about earlier, making contributions to your employer plan that allows you to do Roth, there is no limit on income. You can do that at any income. You make $1 million a year, you can do that. So So those are important things to know.
For sure. Well, I think it's important to highlight too, because you all do work with a lot of folks in the area. You work with certain companies.
We do.
A lot of people have done a really good job of saving in their workplace retirement plan. These tax deferred, these qualified accounts, meaning that you've not yet paid tax on that money. Talk about some of those companies that you work alongside, because there's a step, right? You have to take the retirement plan from the workplace, convert it to a traditional IRA, so it's like to like, but then you can begin doing the Roth conversion. So this takes some planning.
Well, that's correct. Not only that, the issue we hadn't even talked about is what if you have a pension?
Yes.
If you're working for an employer, you're working for a school district, you're working for a state or governmental entity of some sort, where you also have pension income that is going to be generated, that's going to come out in retirement, that's all going to be fully taxable. Probably that's going to create enough income that it's going to make your Social Security 85% taxable. In many cases, it makes almost zero sense for those type of people to be contributing to a deferred plan. They should be making almost all of their contributions to Roth. And I hate to get to general advice again, because we always, talk against that. But for those that aren't going to pick up the phone, please take that advice out there. But for those of you that are smart enough to understand there's a lot more to this than what I really thought, please pick up the phone today. Call the 800 number, scan the code. Let's get that process started so that we can understand exactly what your current situation is, where you're trying to get, and help you develop that written income plan. We literally have a system that we will share with you that can show you the different tax implications of different levels of Roth conversion, since that's the topic we're on today. Again, I don't want to get away from the idea. We want you to see what income looks like through the entirety of retirement so that you have a complete plan.
Awesome. Dale, Mark, thank you so much. To our viewers at home, that number to call to start your journey and receive your very own complimentary written income plan is there for you on the bottom of your screen. 866-724-3893 is the number to call. Or again, you're welcome to scan that QR code and that will get you connected as well. We'll be back with more on how to remove your wealth from Washington right after this.
Think your retirement savings are all yours? Think again. Your 401k, IRA, or pension comes with a tax bill from Uncle Sam. And it could be bigger than you expect. Want to find out how much? Our quick and easy tax calculator can show you right now. Just scan the QR code or visit retirepathtaxtest.com to see your potential tax hit and how to plan around it.
As Americans, we strive for better, from a better house to a better career to a better life for our kids. Better has become the American way. But when it comes to your retirement, what does better mean to you? Does it mean more income, a flexible lifestyle, better options and solutions? A better retirement begins with a written income plan. To get your complimentary written income plan, call the number that you see here. You only retire once, so this is your opportunity to plan for better.
Welcome back to Arkansas Money Talk, where today we have been talking about how to remove your wealth from Washington. Yes, it is possible so that you don't have to pay any more to the IRS than you are legally required to pay. And if you're just joining us, we encourage you to visit this complimentary site, which in a matter of minutes will give you your very own report with a breakdown of your numbers. That site is retirepathtaxtest.com. You can also get there by scanning that QR code. Couple minutes of your time, but what a wealth of knowledge you'll be able to receive and set yourself up for success to begin mitigating your tax bill in retirement. And I think another thing that we want to make sure we touch on for folks is it's not just about lowering the tax burden for yourself while you're alive. What a lot of people don't realize is because of recent law changes, they could inadvertently be passing on a tax bill to their kids, for example, if they're leaving the money. So talk about that and what's changed, because I think there's a lot of lack of awareness of why this matters so much, not just for yourself, but for those that you're leaving the money to once you're gone.
Yeah, I think the main thing I want to point out, folks, we're not tax strategizing so the kids don't have to pay taxes so that we do. The reality is we're dealing with your money. Okay, so all these conversations we're having are talking about the assets you've put together. The reality is that there's two steps in that situation. Since now all assets have to come out from any beneficiary besides a spouse, they have to be limited or have to be fully distributed within a 10-year time frame. So the reality is I've only got 10 years to get qualified money out. But the other side of that coin is if I have those dollars in Roth assets, those kids have 10 years to allow that money to continue to grow there. We're going to have to take small minimum distributions out each year, but there's 10 years for that money to continue to grow, tax deferred, for they have to take it out and do something else with, which gives them a more advantageous runway to get the qualified dollars they do have to pay taxes on out. I think the step that often gets forgotten in the middle there is that in the average instance, there's going to be one spouse that lives somewhere from 3 to 7 or even longer as a single taxpayer. And so when those tax codes get cut in half, theoretically, our tax liability doubles. Okay, folks, that's twice as much tax limitation. 80% of folks out there today are telling us that they're worried about market downturns affecting the assets that they have, but so few people want to, talk about the reality of the situations of what the tax situation.
Well, they don't realize it because it's not talked about enough, which is why we beat that drum, because so many folks, unfortunately, are unprepared for that day when that comes.
Well, not just that. Wealth advisors don't have these discussions.
And the reason is
because they don't understand how to do anything about it.
And also,
or they're prohibited from having the conversation.
Exactly. Yeah.
I hear it so many times, and again, Kristen and I specifically went and looked up immediate data before we did this show. Is that what we hear is my current person tells me, "Oh, go talk to your CPA." we always ask them, okay, do you use a CPA? I don't know. Because the reality is about 53% of all tax returns are actually prepared by a paid preparer. 58% of that 53% are actually prepared by a CPA. The vast majority of people, even that are seeking tax advice, are seeking tax advice from a, don't want to mention names, but the tax preparer around the corner that everybody knows, or the guy in the Walmart booth. I mean, literally, you think they understand what tax code is and how it's going to affect you in the future? And so they're kicking this advice down the road because they don't want to take the fiduciary responsibility of having an honest conversation with someone. So folks, you owe it to yourself, to have a conversation with someone who actually understands how structuring your investments, how taking income is going to affect your tax situation, because your taxes are the one thing you have the greatest amount of control over.
Another strategy that helps folks have more control than they realize is something known as a QCD,
Yes, ma'am.
Qualified Charitable Distributions. Can you touch on that, Mark?
Yeah, it's something that we see quite often because we ask people, and you'll see as some of the things we ask you to bring in, we ask people to bring in their tax returns from the last year. And we'll oftentimes find out, most people are using standard deductions on their tax returns. So they're taking that, but then they're also, most people in Arkansas are charitably minded. They give money to charities, and we see it on their tax returns, but they can't deduct it because it's not more than what their standard deduction is. And a lot of them are, if you're 70 and a half or older, you can actually have your qualified charitable distributions made directly from an IRA to a charity. It never comes into your income, and we're still taking full advantage of the standard deduction. This is a very important part, but we see it missed time after time. Very, very few people that actually come to our office have been using
Are
QCDs.
even aware that they can use QCDs to count for their RMD as well,
That's
right?
exactly
Or even if they know that and they understand the Roth conversion strategy, because the question often is, hey, how do we get all this money out? Well, the reality is, if I'm charitably minded, I don't want all the money out.
Right.
If I can pay zero tax bracket, I'm always choosing that one.
Yeah, for sure. Well, clearly there's a lot more. We could spend hours talking about how to remove your wealth
Yes,
from
ma'am.
Washington. But Mark, Dale, thank you so much for this important conversation. We hope you found it to be helpful and valuable as well. Again, the team of Retire Path Wealth is here for you. You owe it to yourself, especially if you're working with another financial professional and they're not having these kinds of conversations with you, to get a second opinion. So we encourage you to reach out today. That number to call is there for you on the bottom of your screen. Thanks for watching, and we'll see you next time here on Arkansas Money Talk.